Welcome to the Leadership Lyceum, a CEO's virtual mentor. Now, here's your host, Tom Lindquist.
Glad to have you back in the Leadership Lyceum, where we bring you direct access to top CEOs and directors of boards in an interview format that provides insight on situational issues that confront CEOs every day. It is a CEO's virtual mentor. If you didn't join us for our last episode, episode 10, which was a special podcast on innovation, you may have missed the announcement that we formed two companies under Leadership Lyceum's brand. Lyceum Leadership Consulting, which provides executive and board of directors search, board effectiveness review, and an array of services for successor development and board readiness. And Lyceum Leadership Productions, which brings you this podcast. We also announced that we would be expanding the programming of the episodes this summer. Well, happy summer. This is the first of our expanded episodes. Welcome to episode 11, which expands the programming into 3 segments. We'll continue to bring you the in-depth CEO and director interviews around compelling business situations as a main middle segment, segment 2. The main segment will be bookended over the next 3 episodes with shorter segments 1 and 3. At least over the next 3 episodes, Segment 1 will cover board and corporate governance best practices on one hand, and Segment 3 will cover the consequences of deficiencies in corporate governance, namely shareholder activism, on the other. We hope you enjoy this expanded coverage, which we'll be refining over the next few episodes. So please subscribe through iTunes and give us feedback on the new programming. Tell us about leadership situations and subjects that you're interested in us exploring, and please visit our website, leadershiplyceum.com, for all of our archived media and offerings. We'll be right back to start the program. Welcome back to this newly expanded episode 11 of the Leadership Lyceum, a CEO's virtual mentor. We welcome 3 fabulous guests to this episode. In segment 1, the first of a series on corporate governance and board effectiveness, we welcome governance expert Tanuja Dehne. Tanuja serves on 2 public company boards and is a frequent speaker on board governance. Most recently, she was part of the instructor panel for the NACD Advanced Director Professionalism Program earlier this month. The NACD is the National Association of Corporate Directors. In segment 2, we welcome Paul Bonavia, a retired chairman and CEO of UNS Energy, better known as Tucson Electric Power. We'll explore the triggers and interconnected events that have led to remarkable levels of consolidation in the electric utility industry, and Paul's leadership of the sale of UNS to Fortis in August of 2014. In segment 3, the first of a series on shareholder activism, we'll be joined by Chris Young, Managing Director and Head of the Contested Situations Group at Credit Suisse. In the first part of this series, we'll cover the history of activism in the market for corporate governance, growth in the asset class, and answer a fundamental question. What do activists want? We'll be right back with segment 1 with Tanuja Dehne on corporate governance and board effectiveness. Stay tuned. I'm delighted to be joined by Tanuja Dehne. Tanuja is a corporate governance expert and serves as an independent director on 2 New York Stock Exchange-listed company boards. Advanced Disposal Services, a $1.4 billion environmental services company, and newly IPO'd Granite Point, a publicly traded commercial mortgage REIT. She also dedicates her time to not-for-profit board service, including the Geraldine R. Dodge Foundation, Young Audiences, Homefront New Jersey, and Sustainable Jersey. Let's join our discussion. Thank you for joining me.
Thank you. It's my pleasure.
I'll ask you this broadly, but what is the value of effective governance? If there's corporate outcomes that come from good governance where you can say that directly came from a well-tuned governance program?
Where to begin?
Yeah.
I think it all starts with the board of directors, the highest decision makers of an organization. Good governance sets the tone at the top for culture performance, a culture of compliance, but a culture of long-term shareholder value creation. The board is providing oversight and guidance to a management team. But that oversight and guidance is extremely powerful because what that does, it empowers a management team to go deeper, to ask more questions, to be held accountable, to be incentivized to do the things, to do the right thing. And that really starts at the board level. The CEO clearly sets a huge tone at the top, but the CEO is accountable to a board of directors. And so if a board does not value, for example, talent development and talent pipeline, unless the CEO feels in the CEO's gut that this is the right thing to do, there's very little to incentivize the CEO and therefore the CEO's executive management team to be focusing on an organization's, what I would say, the most important asset, their employees. There's a huge amount of value on good governance and board effectiveness. And it has this ripple effect on everything. And if you take the long-term strategic plan that the board is responsible for setting with the management team, then all of the duties of the big three committees, audit and risk oversight to compensation, then nominating and governance. All of these things, I think, help create a board ecosystem and a board culture that drives so many of these important factors for a successful organization.
We'll be right back with Tanuja Dehne on corporate governance and board effectiveness after this short break. Stay tuned. We're back with Tanuja Dehne on corporate governance and board effectiveness. Why should boards want to measure their effectiveness? What might be holding them back from measuring their effectiveness?
I think it's a couple of things. It's status quoism. This is the way we've done it for many years, and it worked. They're really supposed to be focusing on board performance. The board evaluations have kind of fallen into this category of these forms that boards fill out for themselves and for their committees, and it becomes very check the box if you let it. So I'm checking the box, so-and-so said this was the way to do it, but then I haven't looked deeper to really get to the underlying issues. And then what's the data that you're actually trying to derive from that? Why are we doing board evaluations? That seems to have gotten lost. And these are very normal cadence conversations that can happen, just like you would an employee, that would surface uncomfortable issues, but would also surface the conversations that need to happen around what do we need on this board in terms of board recruitment, retention, development, and exit. Perhaps it's time for a director or two to step down. And it may not even be a performance issue. It may be this is not the reality this organization's facing.
But you're sort of defusing this whole conversation by having those conversations appear periodically, it sounds like.
Having these conversations on a clear day, when there's no crisis, with a clear mind, so we can all be objective. What do we need now? What do we need in the future? Let's really look at these evaluations. What's the end goal? What are we trying to achieve with our performance evaluations in the boardroom? And what's not happening now? So maybe there's different ways to approach board evaluations. And then having those conversations on a regular basis and being very honest and open about these conversations in the boardroom about ourselves. We can easily have it about everyone else, but when it comes to ourselves, it's harder as directors.
Let me dig a little deeper on that. Assessing the effectiveness of a board is confounded by the sheer complexity in areas of influence on a board organization. These areas are economic, legal, social, cultural, environmental, technological, and political domains of human and corporate activity. It's largely a humanistic system that renders itself very difficult to evaluate. So as I see it, there's the more statutory side, and then there's all these other sides that have humans operating together. And against that complicated backdrop, there are various approaches to board evaluation and effectiveness review. How do you see these differences between the factual and evaluating those areas where humans interact, the sociological, the behavioral.
A couple of things. You can evaluate against goals. Boards require management teams to set goals, and then you have performance reviews against those goals. Boards tend to have goals, and there's committee goals, but maybe a deeper look at what those goals are, and then accountability on achieving those goals, perhaps even making them more quantitative than qualitative. That's one way to measure, are we doing what we said we were going to do as a board? And again, setting those goals on that clear day and not changing the finish line along the way, I think really can hold a board accountable.
The idea of evaluating the human side of it, the sociological.
So there's a couple of ways to approach that. You could do that on a paper form and you'll get the results that you would expect. People don't, under any circumstances, want to be known as the person who's writing something about somebody else. So one approach I've seen is the lead independent director or the NomGov chair calling directors and asking them to tell me about that. And we'll keep it confidential or we'll share it with the full board, but you had me as an outlet to talk about it, or we'll do them thematically and let's talk about these themes that came up. And that works. That works unless there's a performance issue with the chair or the NomGov chair. And then I've also seen some third parties objectively coming in and interviewing directors with a set of questions that I think really need to be derived as a board together about what are we trying to have revealed about ourselves. More specific than are we an effective board? Are we doing X, Y, and Z? Are we setting the goals? Are we being honest? Are we having the open dialogue? Are our board members engaged? Do we feel that our board members are doing their homework? And really focusing on the board as opposed to management. And there will be a section on management, but what these things can sometimes delve into is a criticism of management. We'd be so great if management didn't give us 500 papers of board materials, or we'd be so great if we didn't get the materials like a day in advance. So that's the path of least resistance, is to go after management. But asking thoughtful questions. So I think ahead of time, if you're going to work with a consultant, a third party, an objective person, come to an agreed set of what are those questions that we want the inquiry to be on, so that we are managing expectations and we also get a similar set of answers. And then have the third party do confidential interviews. And then there needs to be a person on the board, probably NomGov chair, that the third party's working with closely, who has access to all the information, so that if something very alarming has arisen, then you can address that. Or if there's a thematic performance issue about a single person, that there's a way to deal with that. For example, there could be a performance issue with a director. This actually came up today as an example, where there was a long-standing director whose ability to serve was diminishing due to health issues.
I see.
And so the board was very reluctant to do anything about it. But then when a third party kind of came in and shared that, it was more objective. And then there was a gentle release of this person from the board.
How did that person receive that gentle release?
It's never easy. And that's why I think that if there's kind of this regular cadence of these conversations, that it becomes the board's normal course, it becomes the board's normal dialogue to talk about these issues critically, that when the time comes to say that at this point so-and-so should step down, it's less painful. We know it's part of this process. It may be that we have enough financial experts and we need to add something else to this board. Or, this person's skills, they were great 10 years ago and haven't kept up with the education and all that's needed of a director these days. There's a lot required of directors. They have to stay smart on every cutting-edge issue if they're going to be competitive directors.
How do you make progress with the findings?
So hopefully with those findings, there will be a set of recommendations on what to work on. It comes oftentimes in a nice package, and you get to work on it. Say, so based on these interviews and what we have found, these are the 5 things you as board chair need to work on with your board, or you as CEO need to work with the board to manage this board relations, board staff relations, CEO and staff relations. How do you build those bridges? Because those all have to work together in a pretty good unison. And going back to your very first question about good governance, board effectiveness, if you don't have good governance and function at the board level, it's really hard to build those bridges across all those different areas that need bridges to be built.
That ends segment 1 with Tanuja Dehne. Join us for our continuing conversation with Tanuja next month in episode 12. We'll discuss derailers to effective boards and effective leadership styles in the boardroom. And shall I say it? Why not? As a self-promoting reminder, Lyceum Leadership Consulting does provide third-party board effectiveness review. There, I said it. We'll take a quick break, be back with segment 2, our interview with Paul Bonavia on consolidation in the electric utility industry and the sale of his company to Fortis. Stay tuned. You may have read our article in the May 2017 issue of Public Utilities Fortnightly about our next guest, Paul Bonavia. By sheer coincidence, I wrote that article for Fortnightly on April 1st, 2017 in Chicago, Illinois. Exactly 10 years before that, on April 1st, 2007, the Illinois General Assembly passed a resolution designating April 1st as Cheap Trick Day in Illinois. I'm giddy with delight to come as close as I can to a Rolling Stone reporter in featuring this conversation with drummer Paul Bonavia, who in his younger days was in bands with members that would go on to form Cheap Trick. While I'm sure some subset of our listenership is interested in Paul's pre-utility rock and roll lifestyle, this conversation was directed toward Paul's alternative lifestyle as a CEO of an investor-owned utility and the sale of that company he led to Fortis in August of 2014. We'll be right back to start the conversation. Paul Bonavia is the retired chairman and CEO of UNS Energy. UNS is perhaps better identified by its principal subsidiary, Tucson Electric Power. Tucson Electric serves 417,000 customers in the greater Tucson area. Paul joined UNS in 2009, and in August of 2014 closed on the sale of UNS to Fortis. Fortis is Canada's largest investor-owned gas and electric utility holding company. Fortis has been active and acquisitive. It was formed in 1987 with about $390 million in assets, and it's grown to over $47 billion today. Fortis has acquired 3 publicly traded companies over the last several years in the U.S. In June of 2013, they acquired Central Hudson in Poughkeepsie, New York for $1.5 billion. In August of 2014, they acquired UNS for $4.3 billion, and in October of 2016, they purchased the International Transmission Company, or ITC, a Novi, Michigan-based publicly traded transmission operator and developer, for $11.3 billion. Fortis has certainly been part of a trend, and we'll cover that with Paul now. Fortis has certainly been on the buy side and part of a trend. In a prior conversation, Paul, that we had, you noted this remarkable trend. 25 years ago, there were 100 plus independent utilities, and now there are less than 50. I wanted to ask you to start just what are the compelling drivers and values for the various parties or stakeholders in these transactions that is driving this rapid pace of consolidation in the industry?
It is a rapid pace. The less than 50 is a number that continues to dwindle as we have more transactions announced. The trend has been there for a while and looks to continue. The utility business has changed so much from the ones I came to know when I first was associated with that industry back in the 70s as a lawyer representing one of the large utilities. That was actually the beginning of the big era of change, because up until then it had been all about growth. And then came the 70s, and you had economic stagnation, the fuel crises, the oil crises, which were catastrophic. When you were an oil-fired utility and oil went from $5 to $40, suddenly they found themselves in a rising unit cost environment, not a declining. Probably the first time since Samuel Insull in the 1910s or 20s, they saw their sales go down. So fewer sales and these immense capital projects, and then throw in the fuel shock. If the utilities got it right, didn't hurt their profits, but it certainly hurt their customers. And when your customers are suffering in this industry, you have a big problem. So that was where it was in the 70s, and everybody at the time said, oh, the sky is falling. So we all went off and diversified in the 80s. That didn't go very well. We all went into independent power in the 90s. Mostly that didn't go very well. Trading came along. International, right? Spent a lot of time on that in prior jobs. So there's been a continuing series of issues of the day, the major focus of the day, and it's all looked scary to utilities, which in those days weren't really accustomed to those sort of shocks. My view is, as we got into the 21st century, economy was pretty stable, at least up until 2008. Fuel prices were relatively manageable. Capital was relatively available, but then the real change happened. This is the biggest driver of not just consolidation, but of all the other forms of change. And that is, technology came along, and the technology proved economically viable enough that it changed the way people consume electricity. Up until then, it had been all about changing the way you generate electricity. Nuclear was a big thing in the industry, a major shift, combined cycle natural gas, efficient combustion turbines. But all of a sudden, the consumption side was affected by technology. So people could get more energy efficient appliances. That was an easy one. It doesn't sound like some huge dramatic development, but as everyone's refrigerator and pool pump and air conditioning begin to turn over as the new stuff comes online, you really see a difference in usage per customer.
Just the sheer scale of that drives a lot of it.
It drives a lot. After I'd gotten to Tucson, one of the things we did in the first year I was there was to build a new headquarters building. The company had been sort of dispersed out on the edge of town at a power plant site, not very visible and not a very good place to attract professionals. So we said, we'll make a commitment to downtown Tucson. Let's build a new building. Tucson will love it. We'll love it. Employees will love it. Then you begin the process of the planning. Talking to the architects, talking to the constructors and the engineers, they began to bring alternatives for lighting. The lighting in a building is, 30, 40, even 50%. It's a very significant percentage of the energy consumption of a commercial building. And they're talking to me about LED lighting, which at that time was still pretty new.
This is 09 or something.
This was 09, yeah. We all thought the big lighting development was the crazy bulbs. That isn't it at all. It's really LED that's made the big change. And I realized, if we're going to do this in our building, what's everybody else doing in their building? It became clear to me, and I think to an awful lot of people in the industry, that we thought oil shocks and changes in environmental policy and water intake rules and mercury rules and all that, we thought that was a big change. It's not real. Those are all just affect business as usual. You just do your same business somewhat differently. But the availability of commercial, economically viable technology that reduces consumption, that's a game changer. And you're looking at the prospect that your capital investment is not going to go down. It's going to go up because there are all these environmental rules and all the new needs and smart grid and all of the things customers want that require capital investment. You're going to keep investing. You're going to keep going to the capital markets. You're going to keep going to the rate commission if you're regulated, and most everybody is for transmission and distribution, if not generation. So rates are going to go up, but usage is going down. Now your rate phenomenon only accelerates what technology has enabled and what customers are waking up to. And that's a scary prospect. The changes in the way electricity is generated have put a lot of pressure on utilities and created a lot of risk, but the changes in the way electricity is consumed are even more profound, and that's not going away. It'll only accelerate. The real competition that I think also drives consolidation is not necessarily, the legislature might create a competitive supply business. Utilities have sort of learned how to deal with that and how to adapt and have done pretty well. The real competition is the LED light bulb, the efficient appliance, the Internet of Things, the Nest thermostat, all of the things that technology enables. That's competition.
It's going to continue to drive volume, usage down, and force you to cut costs per unit and continue that.
Which is really hard to do.
There's a limit.
There's a limit.
You can only cut so much.
You can only cut so much. You still have to maintain your service, and you still have to keep your regulators satisfied. The worst scenario is to embarrass your regulators, because that never bodes well. Obviously, you're the utility. You need them to see you as a force for good, as a force to help. There's just a lot of pressures out there that fundamentally change the business.
So where does the consolidation relieve? Where's the biggest pressure relief valve, I guess, for the squeeze that's taking place?
That's a good question. I think when people see a lot of developments that trouble them, you start thinking, wow, maybe we need friends here, maybe we need partners or bulk. So there's a psychological component, but you can't let that govern your thinking. You have to step back and say, we've been doing pretty well. Times are always challenging. Let's not do this for some unquantifiable gut reaction to developments. So then that leads you to looking at, well, what can consolidation really do that's more verifiable?
Back at that time when you were looking at your strategic alternatives or maybe being presented with some of them, what were you thinking as a smaller, regionally focused utility?
In our case, we were not looking to sell the company. That was never in the plan. We worked hard on our strategy, and we liked our standalone prospects. The company had been very down back in the 80s and 90s and was a junk credit and had all sorts of regulatory problems and community relations problems and had been recovering fairly steadily since then. And when I came in 2009, we were certainly not all the way to where we wanted to be, but we had a platform that we could work with. By the time I left, we were an investment grade credit and we were trading at a very healthy multiple. And we were a company that didn't feel any pressure to do a transaction, didn't have it in our head that was our future or our principal mode of creating value. But when an opportunity comes along, you just have to look at it from the standpoint of, we have our standalone case and we're comfortable with that. If we can get greater, it would have to be greater comfort with the offer. We just created a lot of value relative to our standalone case and took a lot of risk off the table.
So what did you learn? What did you begin to learn in terms of those components as you engaged in the discussions?
I'll backtrack a little bit if I may. I came from the outside to UNS, and one of their questions was, what about M&A? And I had done a lot of that in previous jobs and as an advisor, and which they knew. And I took maybe a risk by saying, I don't think this company's an M&A candidate. Honestly, I don't think that ought to be your focus. We've got a long way to go to get this company to a trading multiple, credit rating, community perception, regulatory credibility. Let's just focus on the company. Someday we'll be an attractive candidate. For several years, we listened to that politely because our basic determination was we're fiduciaries. None of them rang the bell. Again, if I can back up, our company had a failed deal 10 years before the Fortis transaction. KKR. The company agreed to sell itself to KKR. And that went before the Arizona Corporation Commission and was turned down. It left a very bad residue. Because when you embark on a transaction like that, even if you've got some kind of breakup fee or whatever, it's expensive. Most importantly, you take your eye off the ball strategically. You just can't help but get focused on the transaction. You say you're not going to take your eye off the ball, but still, it's a huge commitment of resources to the process. So that came unglued, rather publicly and spectacularly turned down. Some years later, when I came on the scene, there were still directors who remember that era. They were going to be a very hard sell. And from time to time, we'd get a call. And then I read about Fortis.
Around the Central Hudson announcement?
Or even before that. Stan Marshall was then the CEO, and the current CEO's predecessor. And in the most engaging, disarming Canadian way, he would come to the Edison Electric Institute, where we all do presentations at the financial conference, which you know well about. And he'd make a presentation and say, well, we're the biggest utility in Canada, and if we're going to be a major North American utility, that's got to be the U.S. So for all of you listening, if you're interested, here's my phone number. And I mean, there was nothing coy or disguised about it. It was a very direct approach, not a predatory approach. I mean, just the opposite. first time I ever met with him, he said, we like to do acquisitions, and we're not bottom fishers. We're not looking for broken things where we can squeeze some costs out of it. We want healthy companies. We're smart enough to know we have to pay full price. And we talk to partners by invitation only. You'll never get a bear hug letter. You'll never get any pressure from us. If you want to talk, great, here's my phone number, here's my business card, call me. If you don't, nice meeting you. And that was their presentation. And I thought that was interesting. It's refreshing and it's sort of charming, kind of a Canadian way to be. But they've been very successful.
Paul, with what you said earlier, just about the procedure, the process that you follow if you were to get interest. In this case, you're calling him to inquire. What do you have to do in executive session in that regard?
Well, this evolved in an interesting way. While Fortis was still in the general, we'd like to buy a company mode, I think this was even before Central Hudson. An investment banker, as will commonly happen, called me up, somebody I knew well, did a lot of work for Fortis. I guess this is all reported in the proxy, so I'm not telling board secrets, but he was with Scotiabank, a significant Canadian relationship
bank. Boyd Nelson, is
well, it would indeed be Boyd Nelson.
I know Boyd.
You know Boyd, yeah. And nice guy. And he called up and said, "You know about Fortis, right?" And I said, "Well, I think everybody knows about him now." They kind of made a splash. And Boyd said, "Well, have you ever met these guys?" And he said, "Oh, they're great guys. Stan Marshall's a lot of fun, and I deal with him a lot. It's a big relationship for our bank. So what if you just got together and had lunch or a drink or something?" When you're a fiduciary, I think part of your responsibility is to be well informed. Part of my job was to keep my board well informed, and then they take it where they want to take it. Maybe a decision comes out of it, maybe it doesn't. Curiously enough, we met in Chicago, and as I recall, it was December 1, 2012.
So 2 years before the transaction.
Stan was there, Barry Perry, who's the current CEO, was then the chief financial officer, were there, and me, and Boyd. We met for breakfast and had a couple hours of conversation, all very pleasant. And again, the Fortis guys reiterated their approach. We use a federation-type business model. Our home office is in St. John's, Newfoundland. We don't have somebody in Newfoundland that we want to send down there to tell you how to do things. It's not at all how we operate. We've acquired a lot of utilities. We've never sold one. We believe in growth. We want strong companies with a strong management team. We are not looking for a bargain, nor are we looking to come in and take people out. Part of what we would need to know in our own diligence, this being Fortis, is that you've got a good management team that'll stay with us. It takes all day to get to Tucson from St. John's, Newfoundland. So they said, we're not going to be just jetting back and forth. So your management team would continue to plot your strategy, your budgeting, your CapEx, your regulatory relations, and we would need a strong local board. These are not concessions that Fortis would make. These are part of our business model, and in fact, they're requirements. That was the second time I'd been surprised a bit by Fortis and had to chuckle, is nobody ever says that. I mean, they'll give you all the reassurance in the world, but if it's an investment fund, an infrastructure fund, you know that they've got a set of different priorities. They've had to raise money. They've had to create a fund. The fund has a termination date. They've got milestones. Fortis was much more disarming in saying, we're utility guys. Mm-hmm. We're not bankers. We're not financial sponsors. We're not investors. We run a utility. We want you to run a utility. We just want it to be part of ours. And we think together we'll be stronger.
Let's take a quick break. We'll be right back with Paul Bonavia, retired chairman and CEO of UNS Energy. We're back with Paul Bonavia, retired chairman and CEO of UNS Energy. It's amazing because their requirements are exactly what your Public Utility Commission, what the ACC would want you to do.
Yeah.
Local leadership. They've got somebody that they can call on right there and deal with locally. It benefits your employees and the management team and the successors that you created.
It was very compelling in that sense. flying back on the plane and putting together notes for what I was going to report back to the board, I thought, for the first time, this might just be interesting. From many conversations with the board, I knew that they weren't interested in another KKR-type transaction. So I reported that to the board, and nothing came of it. All had a nice conversation. Shortly after that, as I recall, Fortis announced its acquisition of Central Hudson. Mm-hmm. That kind of took them off the playing field.
Sure.
You can only do so many of these at one time. And we, at the Tucson Electric Power affiliate, we were going into a rate case. And rate cases in Arizona are policy forums. But in Arizona, sort of the philosophy of it is, if you're going to make significant decisions about solar energy, demand response, what to do about fixed costs versus variable costs as customer usage declines, what to do about inclining or declining block rate structures, all of those things which are seen as policy issues get pushed into rate cases. Mm-hmm. TEP, we hadn't had a lot of rate cases. So here we go. Fortis has got the Central Hudson transaction. We've got a rate case. So we all just agreed we'll be friends.
Yep.
Eventually, we did indeed settle the rate case. Fortis eventually got their transaction approved in New York and acquired Central Hudson. We had a board meeting coming up. Just before that meeting, I got a call from a friend with one of the infrastructure funds. Having had these overtures from a couple of other serious overtures. The next board meeting was a few days later. I sat with the board and I went through the infrastructure fund and I went through the conversation with the other utility. And one of our directors surprised me a bit. This was a director who I think probably was traumatized by the KKR transaction and didn't want any part of that, didn't think that was a good idea. But he surprised me by saying, every time we meet, you'll tell us some story or about some phone call or somebody dropped in, but nothing ever comes of this. Why don't we find out what these people think the company's worth? Of course, we had talked long and hard in planning sessions and with our bankers about the market out there and what's going on. He related it back to that and said, what's the point of having these people come in here and give us their analysis of the market if we don't ever learn what that means for our company? We don't have to say yes, but I'd kind of like to know what some of these guys think we're worth. We're done with the rate case. And I said, and they're done buying Central Hudson. So we're both free of our shackles. My counterpart there, Stan Marcia, was very polite and cordial about it and said, we can give you a price pretty quickly. We've done this before, and we've also followed your company pretty closely. So let's sign our confidentiality agreement and get to work. One of the key questions you have when you start down that route, do you have a duty to conduct an auction? Or can you negotiate with one potential buyer? After careful consultation with counsel, we were advised and discussed in the board that no, we really thought we could just talk to one buyer. And if I were handicapping it that early in the process, I would have said, this is a 1 in 4 or 5 probability. But we're going to do our duty as diligent directors to find out what a real buyer with a real experience that knows how to do a transaction, has money to pay for it, would pay for our company. And then we'll compare that to our standalone case, and it will give us very useful information. So we went through that process. Then we got to our board retreat. A number came in. When we got to the board meeting, and I provided them with the letter I had received from Fortis, which included a price, and we were trading maybe in the low 30s per share. It was a significant premium. That was their opening bid, and of course, you know that's an opening number. And I just remember one of the directors, more of a dove than a hawk on the transaction, looking at me and saying, "Are you kidding?" He said, I'm impressed. I thought this would be a kind of a diversion from the strategy session, but this is not a diversion. We're going to take this seriously. And we did, because of course, we get to the end of the meeting, I had to ask him, these guys are going to be expecting some communication here. I'm going to have to call him. What do I say? Do I say, thanks but no thanks? We're done? The sense of the board was, well, no, we're not done. By no means are we at yes. Probably we won't get to yes, but we are not at a point where we're willing to say peremptorily, thanks, go away. So, okay, the game is now afoot. And I called my friends at Fortis right after the meeting and told them. And over the next 6 weeks or so, we met several times. We did the usual management presentations. We did all the things you do in your diligence. I just made the decision, I'm going to do this with Stan Marshall. We'll do the number. Lots of room for the lawyers and the bankers to fill in other things, but this is a cash deal. We want it as clean as we can make it. You have to create a set of criteria that you're going to use for decision making. And our friends at Fortis, they met all the criteria. Independent management, independent budgeting, independent regulatory relations, but backed by an A-credit parent that could bring a lot of strength and a lot of best practice. We would keep the board and have a majority of non-Fortis people or carryovers, which would work well in the community. No layoffs. We were confident we could get support from our union. Given that we'd had 2 busted transactions, we wanted a high likelihood of success. Fortis had all of the credentials. The timing felt right when we're at the top of our value game. I called them up and said, why don't you come talk to our board directly? Take an hour and tell them your story without me being the filter. So we did it on a Sunday morning at a hotel near the Phoenix airport, and we had gotten ourselves to where we were comfortable with the people, with the structure, with the approach. You know, the price was the very last thing.
So it was $4.3 billion transaction. I think that equates to a $60 share price?
$60.25. I had told the number has to have a 6. Anything we get above that is going to cover some fees. It's nice that just psychologically, it's got to be $60, and if I can get a little more, I will. And that was a hard decision for the Fortis board. They have since found that it worked out very well for them, too.
Looking back at your tenure then at UNS, you come in, you're there for 4 years. I think when you started, the stock price was $28.11, something like that.
Yeah, I think that's right, because I have some options that were priced, and I think that's right. So we more than doubled the share price from January 1, 2009 to we closed in August of 2014. And we doubled the dividend during the same period. And we went from being a junk credit to being an investment grade credit, and we improved operation. Most important to me is safety. That's my favorite operating metric, and our safety performance improved considerably. It was actually so from 09 to 14 is 5 years. So it was 5 years and change total. Late 2013, I mean, we made Dave Hutchins president.
Congratulations on a great 5 years, Paul, and a fairy tale conclusion. We'll take a break and be right back with our concluding segment of this episode. Stay tuned. Welcome to our final segment in this episode on the dramatic, consternation-filled subject of shareholder activism.
We know now this world was being watched closely by intelligences greater than man's, and yet as mortal as his own. We know now that as human beings busied themselves about their various concerns, they were scrutinized and studied, perhaps almost as narrowly as a man with a microscope might scrutinize the transient creatures that swarm and multiply in a drop of water. With infinite complacence, people went to and fro over the earth about their little affairs, serene in the assurance of their dominion over this small, spinning fragment of solar driftwood, yet across an immense ethereal gulf, minds that are to our minds as ours are to the beasts in the jungle, intellects vast, cool, and unsympathetic, and slowly and surely drew their plans against us. Near the end of October, business was better. The war scare was over. More men were back at work. Sales were picking up.
That's Orson Welles in his introduction to his panic-producing 1938 radio masterpiece, War of the Worlds. For the Lyceum, it's a bit of an allegorical backdrop of an environment well-suited to some alien form of activism, perhaps? This is our series on shareholder activism, and we're joined by Chris Young, Managing Director and Head of the Contested Situations Group at Credit Suisse. In this first part of the series, we'll cover the history of activism and the market for corporate governance. growth in the asset class, and answer a fundamental question: what do activists want? As a backdrop, the Wall Street Journal reported recently that shareholder activism, which has been a perennial nuisance for chief executives, is now becoming an existential threat. Activists are going beyond just settling for board seats and are waging campaigns that target changes in top management at the outset. So far in 2017, and this is going back a few weeks, but so far in 2017, activists have started 9 campaigns targeting top management. This is the fastest pace on record, according to FactSet. I've represented 2 clients this year from the power and utility industry on board searches in the face of shareholder activism. And while 2 companies experiencing activism does not constitute a trend, my clients' experience of late certainly seemed to warrant raising awareness with our CEO's virtual mentor listenership by featuring this fascinating and informative conversation with Chris Young. I'm here with Chris Young in New York at Credit Suisse. Chris is the managing director and head of their contested situations group. Chris is a lawyer by training and by foundation, and then investment banking, I think, in the technology sector. And then, interestingly and relevant to our conversation, spent a little over 6 years at Institutional Shareholder Services, or ISS, as everybody knows it by. Chris joined Credit Suisse 7 years ago and leads the Contested Situations Group.
That's right.
Thanks for hosting me today, Chris.
Thank you. Thanks for having me.
This conversation today is about activism, and you all refer to it as contested situations. And shareholder activism in some type of planned and directed form conjures images of corporate raiders from the 80s, Predator's Ball, Barbarians at the Gate. The contemporary form of activism seems less hostile, or perhaps the euphemism sounds a little bit less hostile in the terms that you describe it as contested situations. But what is activism, and how has it evolved over time?
It's a good point. I think the current activists are sort of the next generation of what we used to call corporate raiders. I think the major difference is back in the 80s, the raiders actually would make plays to take over 100% of the target company. And beginning in the beginnings of the 2000s, say 2003, 2004, when you had guys like Bill Ackman, form Pershing Square, Nelson Peltz form Trian, and Jesse Cohen at Elliott and other well-known activists sort of start plying their trade. The bigger difference was that they would take a small stake, often 5 to 10%, never seeking really to take over the 100% of the equity, but seeking with that small stake to have influence over the strategic direction of the company, its use of the balance sheet, capital allocation. I've heard a well-known activist make that statement that the genius behind activism from his perspective is that you can take a non-controlled position, a small stake, not pay a control premium, yet exercise some degree of control over the company. And that's why they're willing to take on all the costs and added bandwidth to run campaigns, right? Expensive, time-consuming way to invest rather than to sort of pick a stock and sit back.
As we were in production on this podcast, Daniel Loeb, founder of activist investor Third Point, demonstrated this activism genius by accumulating a small 1.25% stake in Nestle, published a letter on a Sunday, and 2 days later, Nestle announced a $20.8 billion share buyback, as well as clarifying other strategic objectives. Back to Chris.
I think that's the biggest difference, and now it's considered an accepted asset class, so endowments, charities, pension funds, wealthy individuals, when they're allocating capital to different investment strategies. For example, hedge fund research, well-known database, tracks activism as a hedge fund strategy, has for a number of years. So just like convertible arbitrage or long-short equity, activism is a class that you can allocate investment dollars to, and it's generally been, if you look at the data that HFR provides, activism on balance, of course on average, not every situation's a winner, has outperformed most of the other hedge fund strategies. So with that, you had a lot of money allocated to the strategy.
How much have you seen that allocation shift with some of these endowments?
Yeah, well, I mean, you can, again, using the same databases, we don't track it, but using third-party databases, they estimate over $100 billion U.S. is allocated currently to activism. That's up from virtually nothing 15 years ago. So we are at sort of the high water mark for activism as far as capital allocated to the strategy. And that's why you see so many campaigns, both public and private. There are other databases that if you look at how they track the number of campaigns, say in the United States, last year was north of 400, the way they define it. You can define it different ways, but suffice to say that we are at a high water mark for number of campaigns. A little bit lower than the year before, but still north of 400, which is a lot of activity.
Yeah, it's a lot of activity, and you show the trend line in your corporate insights document, and it's a pretty steady trend.
There's and it's going to continue to go up and to the right, as I say to our corporate clients, as long as it continues to earn money, right? Or be a successful strategy. People ask me, when is it going to end? It won't end until it stops working.
Chris, you talk about the money coming into that sector, that class of investments. Also, ISS, you were there for several years. Yeah. That's grown tremendously. I think they have over 60% of the market for what they do.
Sounds right.
And I wonder if you can describe ISS's evolution and what's prompted that.
ISS was founded in 1985. I think they have a first mover advantage. When nobody knew what the words corporate governance meant, they were there forming a business around it. ISS was started by sort of a true believer in good corporate governance. Bob Monk's, again, back in 85, this is just my view, was in the early days, it was almost like not-for-profit sort of organization. It was for-profit, but I mean, it was more of a group of people that thought corporate governance was important, thought that shareholders needed to be more mindful of their investments from a governance perspective. I think the pivot point really was the high-profile scandals at the Enrons and the WorldCom Tycos that all took place within a few years caused the government, on the one hand, institutional investors on their own, on the other, to take corporate governance more seriously. The theory became, if we monitor our portfolio companies, the boards of directors, the votes every year more closely, we will avoid these big scandals and huge monetary losses. And I think that flipped the switch. There are other regulatory changes that encouraged investors really to spend more time on it. Instead of just passively deferring to management, they were going to become more engaged, but they didn't have the infrastructure set up. And ISS happened to be there really with almost a monopoly position. They've got some competition now with Glass Lewis and some other proxy advisory firms. So again, ISS happened to be at the right place at the right time to meet that new demand that the marketplace was putting on institutional investors. But they had a big head start in being the outsourced service provider, soup to nuts, corporate governance, research, voting, services, et cetera. So if you're a mutual fund like a Fidelity or T. Rowe Price, you have to vote on so many names at so many annual meetings every year and special meetings of shareholders. It was seen as a way to sort of outsource some of those costs in the classic economies of scale business. What they didn't have is, as they became more influential and where their recommendations could swing, for example, a merger vote, they came under more scrutiny, as you would imagine. And as you know, activism, or much of the hedge fund activism, focuses on financial and economic demands. ISS continues to fill, I think, an important role and continues to expand globally. But I do want to point out that some of the large funds like BlackRock and Vanguard and others have invested significantly over the past 15 years or so in building out internal teams, right? So they still take ISS, Glass Lewis research, use it as a tool, but they certainly make up their own decisions on the high-profile, contentious situations. ISS recommendation at that point would only be sort of one of the inputs because they had been criticized for outsourcing too much of that.
Let's take a quick break. We'll be right back with Chris Young, head of contested situations at Credit Suisse. We're back with Chris Young, head of contested situations at Credit Suisse. What do activists want, and how has that changed over time?
To try to simplify it for our clients, I always talk about 4 buckets of activism. M&A, sell the company, or a subset of that would be break up the company. and get re-rated on different businesses, or sell your non-core businesses, focus on your core. That would all be M&A related. Balance sheet, pretty straightforward. Usually the argument, you have too much cash on the balance sheet, return it in various ways, either through a dividend or share repurchase. Governance, really not really usually the focal point or the driver, but often a request for board representation, a request maybe for some changes in compensation practices and other things. For hedge funds, that's not usually the driver, but it's a means to an end. If they can get on the board and have some say from the inside and implement maybe some balance sheet and M&A changes. And then the fourth bucket is what I call operational. It focuses on the income statement more than the balance sheet. It's where the activist purports to have ideas on how to run the business better. So it's not financial engineering. It's not balance sheet optimization. It's not pure M&A. It's we're going to help you improve your margins. We're going to help you run more efficiently, help you cut costs in a way that doesn't hurt your business. Historically, that's been a hard form of activism to deploy because companies and advisors can say, hey, these guys are traders. What do they know about running a retail operation, a utility, whatever the case may be?
You have three areas, M&A, balance sheet, and operations performance, that I can't envision actually effectuating or influencing without the governance. So how, in the absence of getting representation on the board, are you able to effectuate the other areas?
Yes, that's a good point. That's why I usually say governance, that bucket is a means to the end.
Yes,
and the end is the
yeah.
other three, M&A, balance sheet, operational. I'd say that plenty of examples where the activist does not get on the board, just threatens to run a proxy fight, and then the company decides not to fight. Maybe they've gauged investor sentiment and determined that they may lose that vote, and therefore they agree to do a buyback, for example, or they agree to sell a non-core business line without any of the governance changes, right? And so the activist is able to accomplish one of the other three goals without actually having to change the governance. Now, the threat of changing the governance typically has to either be stated overtly, or it's the elephant in the room that everybody knows is there as the weapon, the stick that the activist can use. While you're negotiating what we would call a settlement. You either decide to fight because you determine that the activist is wrong and it's in the best interest of the company and the shareholder to fight despite the expense and the bandwidth that you have to devote to a fight, or in many cases, and the data shows us, there are settlements that you meet halfway and you agree to do part of what the activist is looking for and maybe refuse to do something else. And sometimes the settlements do include board seats.
That ends segment 3. We'll continue this discussion with Chris Young in late July with episode 12. We'll cover more on the mainstreaming of activism as an asset class, and we'll take apart the activist playbook and take you step by step through the escalation path. This also concludes the overall episode 11. We hope you enjoyed the expanded programming. We'll be back with episode 12 at the end of July, featuring more on corporate governance with Tanuja Dehne, and activism with Chris Young, and an interview with Alan Leverett, President and CEO of WEC Energy Group, otherwise known as Wisconsin Energy, in Milwaukee, Wisconsin. WEC has been highly acquisitive over the last decade. Alan and I will discuss the company's significant growth that has led to a uniquely different collection of operating assets over that time period. As we sign off, we wrap with another new spot on our program called Famous Last Words. In keeping with our War of the Worlds shareholder activism allegory, we'll leave you to be restored to the real world in the good hands of an out-of-character Mr. Orson Welles.
This is Orson Welles, ladies and gentlemen. Out of character, to assure you that the War of the Worlds has no further significance than as the holiday offering it was intended to be. The Mercury Theater's own radio version of dressing up in a sheet and jumping out of a bush and saying boo. Starting now, we couldn't soap all your windows and steal all your garden gates. By tomorrow night, so we did the best next thing. We annihilated the world before your very ears and utterly destroyed the CBS. You will be relieved, I hope, to learn that we didn't mean it, and that both institutions are still open for business. So goodbye, everybody, and remember, please, for the next day or so, the terrible lesson you learned tonight. That grinning, glowing, globular invader of your living room is an inhabitant of the pumpkin patch, and if your doorbell rings and nobody's there, that was no Martian, it's Halloween.
This podcast, Leadership Lyceum, a CEO's virtual mentor, has been a production of the Leadership Lyceum, LLC. The only purpose of the podcast is to educate, inform, and entertain. The information shared is based on the collection of experiences of each of the guests interviewed and should not be considered or substituted for professional advice. Guests who speak in this podcast express their own opinions, experience, and conclusions, and neither the Leadership Lyceum LLC nor any company providing financial support endorses or opposes any particular content, recommendation, or methodology discussed in this podcast. This has been a production of the Leadership Lyceum LLC, copyright 2017, all rights reserved.